Hi, I'm Mary Rafa and I'm a CPA and I currently work in a public accounting firm. Today we will be discussing about real estate accounting and tax rules. For an overview, here are the things you will learn on this course. First, you'll get to know about capital assets, what are the types of properties under capital assets, how do you calculate the adjusted basis of the capital assets. You also get to calculate capital assets gain or loss, and the order of priority in net capital gains, net capital losses, and the tax treatment for net capital gains and net capital losses. And you will also learn the rules about sale of personal residences and the calculation involved. Just a heads up, this course it will not talk much about the concept. This course will talk about more of the formula. The concept, you can find it online in irs.gov. However, what I noticed online is it's really hard to grasp the formula that you have to do. And this what this course is about, is to provide you the formula. If you already know the concept to it, now it's just about applying the formula to the calculation. Thank you and I hope you enjoy it. Welcome back. In this chapter, we will learn about types of properties under the IRS rule. And these are the types of properties: accounts receivable, notes receivable, trading stocks, inventory, certain U.S. governmental publications, property held primarily for sale to customers in the ordinary course of a trade or business, Section 1231 assets, and that includes the depreciable property using trade or business. And also number 8, real property using trade or business is also part of Section 1231 assets of IRS. Number 9 is capital assets. 10 is patent, invention, unpatented model or design, patented model or design, secret formulas, secret processes, and copyrights. 11, literary, musical, artistic composition, letter memorandum, and any property created by the taxpayer. Note that on this course, you need to have an accounting background to understand the concepts here. This course is really for advanced accounting students, and my intention on this course is to provide you the formula, so this way it will be easier for you to apply IRS guidance. So if you need more information about these types of property, please feel free to go to irs.gov, and also you can search online for these. I'll see you on the next chapter. Thank you. Welcome back, and thank you for taking the real estate accounting and tax rules. On this chapter, you will learn about the differences between short-term capital asset and long-term capital asset. So what is again capital asset? Capital asset is any property that you use for that's for personal use. So it's any property that you use for personal purposes. So if you are using a land or a machinery for business, that is not capital asset. And there are two types of capital assets. It's short-term capital asset and long-term capital asset. Short-term, this means that you have that asset for less than 1 year. And long-term capital asset means that you have that asset for more than 1 year. So when we say have that asset in IRS rule or accounting rule, they use the term holding period. Holding period, or the period where you have that asset, that you own that asset, it starts from the day you purchase the asset. So, and it ends in the day that you sold that asset. So when you purchase the asset, even though you have not received that asset yet, it has not been delivered, but once you purchase an asset and the title of that asset transferred to you, depending on the agreement, when who is the legitimate owner of the asset, even though if it's still for delivery, that day counts as the first day of the asset. And of course, if it's a property like a land, and it counts on the day that you hold the title of the land. And the day that you sold the asset is the day that the sale was no longer part, it is the day that the asset is no longer yours. And that's the holding period. Counts from the day you purchase the asset to the day you dispose the asset. And the formula to calculate the cost of the asset, which is your capital asset. Again, capital asset is a property, machinery, or real estate, or any other tangible property that you use for your personal use. It's called capital asset. And to calculate the cost for that, that's original basis plus capital major improvements less accumulated depreciation. So how do you calculate the original basis? Original basis is the cost that you paid in cash plus the loan. If you paid with credit card or you apply for a loan with that, and other services that you have to do to attain that item or that land. And if you receive that item through an inheritance, you will also need the date the debt of whoever gave you that property, because you need the fair market value of that property. And the fair market value of the property is at the date of the death of the person who gave you the property for inheritance. But if you receive it as a gift, then all you need is to get the basis of the donor, the one who gave you the gift, on how much he recorded it in his books. Okay, and then once you have that cost, you add the sales tax, freight, installation, testing, excise taxes, revenue stamps, real estate taxes that the seller agrees to pay, liability assumed for the seller, charges for installing the utilities, settlement fees, and these are all the settlement fees. That's the first one is the charges for installing utilities, legal fees, title research fees, preparation of the sales contract and deed, recording fees, survey fees, transfer taxes, owner's title insurance, taxes seller agrees to pay, interest the seller agrees to pay, recording fees seller agrees to pay, mortgage fees the seller agrees to pay, charges for improvements seller agrees to pay, charges for repairs the seller agrees to pay, sales commission that the seller agrees to pay. And these are the settlement fees so that you can add to the donor's basis. So even though it's the seller who paid for this, but if the person who gave you that property and you look at his books about how much is the cost of that property in his books, you can still add all these settlement fees when that property was acquired before it was donated to you. And so now you have the formula for original basis, and now you want to know what are classified as capital major improvements. So and we can discuss that capital major improvements on our next disc. Thank you. Welcome back. So to continue, what are the capital improvements? Or these are the major improvements for the property, let's say real estate. So these are, for example, the restoration of the property, amounts which result in an increase in the value of the property, amounts that substantially increase the useful life of the property, and this applies probably to machinery. Amounts to adapt the property to a new use, architect fees to plan an addition to a building, cost of the addition to building, cost of the additions. So these are the capital major improvements example that you can add to the original basis of your capital asset. And again, capital asset, this is like a personal property that is, it's personal property because it's used for personal reasons, and that includes real estate and other tangible properties. And then you will need the following documents to support your numbers on your tax return. One is you will need a buyer's settlement statement, which is HUD-1. And this one is this is where it can help you get all of those settlement fees that you can add to the cost of your capital asset. And if you receive the item through an inheritance, you will need a fair market value of the property at the date of death of who gave you that property. Or if you receive it by donation, you need to get the fair market value of the property at the date of the gift. And you will also need to get the donor's basis of that property with the other settlement fees that the seller paid for that property that the donor gave you to be added to the cost of your capital asset property. So thank you for listening for this chapter, and let's move on to the next one.